Hello and good evening, everyone. Today's webinar topic is how to plan your cross-border finances as a NRI or returning to India. So for this, we have with us Vishal Dhawan sir. Vishal Dhawan sir is a certified financial planner and the founder and CEO of Plan Ahead Wealth Advisors, a SEBI registered investment advisory firm. With over 28 years of experience in financial services, Vishal specialized in helping residents and NRI investors achieve their life goals. He is a recognized thought leader, award winning advisor, and passionate advocate of life and across border financial planning. Vishal also frequently shares his insights through columns and radio shows and through television appearances. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by SEBI, the regulator of the securities markets in India. The institute, which carries out a wide range of capacity building activities at various levels, aims at enhancing the quality standards in securities markets. Now, before beginning the session, I would like to request all the participants to note some important points. First, question will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on the NISM YouTube channel. Now I request Vishal sir to begin with this session. Yes, sir.
What I'm going to try to do is run through four key themes for NRIs. One is the foundational banking and investment management piece. The second is what can they think about the real estate strategy, both from an India perspective as well as for assets that they have overseas. The third is the tax and compliance across borders. And the fourth is the risk management piece, essentially insurance and protection of assets that you might have already created. And in order to make it simple, what we're doing here is breaking the conversation up into two parts. One is the outbound journey, which is essentially that if you are someone who's leaving India, becoming an NRI, how do you need to approach that piece? And in part two of this conversation, we'll talk about a situation where you actually are exploring or have come back to India, and how do you need to explore that piece? Um, so we'll start off with the outbound journey. Essentially, you are planning to leave India. Maybe it's temporary, maybe it's more permanent, but essentially the entire framework with which you need to think about your finances is what we hope to cover in this part. So first of all, let's start with your bank accounts. Uh, the first and most important thing that you need to do is when you're moving overseas, you want to convert your savings accounts in India as an individual to non-resident ordinary accounts. Essentially, what are non-resident ordinary accounts? Non-resident ordinary accounts are accounts more popularly called as NRO, which allow you to receive income that will emerge in India. You might have a house which you will rent out. That rent has to come to your NRO account. You might have certain stocks that you have bought while you were in India. Those dividends will need to come into that NRO account. You might have a pension that you will get because maybe you are contributing to some retirement account. That pension will come to an NRO account. So essentially, all income that will get generated in India from assets that were created in the past will actually come into this NRO account, which you need to do as soon as you plan to leave the country. In order to open an NRO account, there might be a confirmation the bank will need that you actually have an overseas address. They might ask for a copy of your visa. So you need to have that in place so that your accounts can get converted from a resident to an NRO account. The second thing that you would want to consider doing is open a new account for what is called a non-resident external, or more commonly called an NRE account. This is essentially for depositing your foreign earnings that you might have. So if you want to send money back to India, either for investments or for any other purpose, you may want to use this NRE account because the advantage of it exists that whenever you want to repatriate any money back, let's say you send the money to India, and after a while you want to send it back to the country from where you sent the money originally, this can happen very easily because it's a fully repatriable account. And the interest that you earn on this account is also tax-free from a India perspective. So there's no tax that India charges on interest earned on NRE accounts. In addition to that, one of the other accounts that you will commonly hear about is what is called the foreign currency non-resident, or in short, called the FCNR account. This is basically a place where you can hold money in a foreign currency asset itself to prevent against any sort of currency fluctuation. So the difference between an NRE account and an FCNR account is that the FCNR account will be in dollars, in pounds, in yen, in euro, in any of the foreign currencies, while the NRE account will be in INR, in Indian rupee, but allows you to be repatriable fully. One of the very important things that you need to do before you leave is simplify your banking requirements, because what is going to happen is your accounts will become dormant after a period of time. If you have to collect information about your bank accounts, you will have to sit and approach multiple banks to get all the data. When you're tax filing, it will create a lot of complications. So, what you need to do is please ensure that you're simplifying your life before you leave the country so that going forward it is much easier. We would suggest that at the very least have one NRE and one NRO account, and try to do, if at all absolutely necessary, then have maybe one more set of NRE and NRO accounts, but please don't keep some accounts left as resident, some left as, you open too many bank accounts. I think it complicates your life very significantly. Now, moving from bank accounts to your investments, essentially stocks and mutual funds, one of the things you'd want to do is convert your demat accounts from resident to non-resident. This is also mandatory and required to be done for holding your securities and also for trading on securities. And what you'll have to do is when you convert your demat account to non-resident, you will also have to link your NRO bank account to these investments. You cannot have a demat and trading account as a non-resident, which is linked to a resident savings account. So this is where it's important to ensure that you put all of this together. There is no compulsion for you to hold all your mutual funds or sell all your mutual funds or hold all your stocks or sell your stocks. So you have certain uh, benefits that arise which are available for you to take advantage of the fact that you can continue to hold or sell depending on what your requirement is. There may be at certain points decisions that you may take because in the foreign geography that you go to, holding a particular type of asset may be less beneficial. So that is not linked necessarily to how India deals with those types of mutual funds, for example, but it is linked to that particular geography. So, for example, you would find that a lot of people might tell you, if you're going to the US, that avoid holding mutual funds if you're going to the US. Holding direct stock is more favorable from a tax perspective. One of the other things that will happen to you when you move out of the country is your assets, which are now held as NRI in stocks and in mutual funds. The tax deduction at source rules may undergo change. So what happens is, as a resident, there may be no TDS, but the moment you become an NRI, if you sell any of these assets, the tax that you make gets deducted at source. You have the option to claim it back as a refund if you have no other income that is subject to tax. But essentially, that's a shift that will happen from an India perspective. In terms of fixed deposits, what happens is that your existing resident fixed deposits, the interest which you earn on those fixed deposits will continue to be taxed, because essentially whatever interest you earn through an NRO status will continue to be taxed, and the maturity proceeds will get credited to your NRO account. While in the case of new deposits that you create, you have the option to create an NRE deposit. The advantage of an NRE deposit is that there is no interest from a tax perspective, and it's also fully repatriable. But it's very, very important to remember that the tax exemption on interest is specific to India tax laws. In the geography that you move to, there may be different rules for how tax on international investments are treated, including the tax on interest earned on fixed deposits. So do not assume that the tax treatment is tax exempt on interest in both the geographies. And that's why cross-border tax planning is a very important part of your entire journey when you move out of the country. The other thing that you want to keep in mind is your PPF account. A lot of investors will typically have PPF accounts while they were in India. You have the option as an NRI investor, once you become NRI, to continue to hold your PPF account, which was held as a resident. You can also continue to make contributions, but this can happen only till the point that you finish your first 15 years of maturity. You cannot do this um, subsequently, uh, because what ends up happening is that there is a sorry, I'm just wondering, is my screen visible to all of y'all, or is there some challenge on the screen? Okay, so let me just bring that back up. Sorry about that. So essentially what happens is that if you look at your PPF journey, you'll typically find that you can contribute for the first 15 years, but once it matures, unlike a resident, you have no option to extend your PPF account in blocks of 5 years. So this is something that is very important to keep in mind, that this is a shift that happens when you move out of the country. Also, your interest and the final maturity amount may continue to be tax exempt from an India perspective. But in the law of the tax laws of the country that you move to, there might be a different status. And therefore, what you want to keep in mind is that do not assume that because it is tax free in India, it is also going to continue to be tax free in the other geography. Moving forward from here to the second part of what we had discussed, what we had mentioned is the real estate strategy. So, as far as real estate is concerned, if you own real estate in India and are planning to move out as an NRI, you have three options available with you. Option one, rent out your real estate. What it does for you, obviously, is it gives you a consistent passive income stream. Of course, this will go to your NRO account like we discussed earlier. It also allows you potential property value appreciation while you're outside. And it prevents you from having to take big decisions at the time that you're moving out, because you're not sure necessarily whether you will come back to India, in what form you will come back to India, how you will come back, etc. The disadvantage is that this income will be taxable, rental income from an India perspective. It may also be taxable in the geography that you move to. And you need to find someone who will manage this property for you when you rent it out. So either you need to have a family member who will do it for you, a friend, a property management service, because in all likelihood, there will continue to be questions that will come to you from your tenants and items that need to get addressed. And you will have to figure out a way to address those items efficiently, considering that you're not in the country anymore. The second option is to sell. Now, the advantage that this obviously has is that, it unlocks capital. This capital can be used for all kinds of choices that you make when you move overseas. You could decide to move to, you could keep that money for expenses, a part of the money for investments. I mean, you have a lot of options. You don't have to worry about managing the property. It simplifies your financial holdings. So there are lots of advantages of selling. The disadvantage, of course, is that you may not be able to participate in potential capital gains if real estate in India goes up. And you may also have to pay capital gains tax when you sell that asset. Plus, if you decide to come back, reasonably quickly, because maybe you didn't adjust well to this transition, you may have to go back and then once again find the property that you wanted to um, buy and appeals to you. The third option is to do nothing, which is essentially you lived in that asset, you now keep it vacant. And the advantage of that is there are no tenant hassles. But typically, what you end up doing is you end up finding that there will be no income from this asset. There will be maintenance costs. There will continue to be property taxes. There could be security risks where someone could, come into your home and either, take possession of your home or do other things that you may not want. And also, when homes are kept shut, as many of y'all would know, they tend to deteriorate very quickly. So each of these options typically will have their own advantages and disadvantages. And what we normally suggest to a lot of families who are making this transition is initially rent out the home unless you are going to visit India very, very often during this period. And once you have decided whether you're going to retire overseas or live overseas for a very long period of time, that's the time that you decide to actually sell the property. The advantage of selling the property while you're still a resident Indian is that there are two ways that you can get real estate taxed. One is through the indexation. This is if you bought your property before a particular date, which is July 23rd, 2024, or you can just pay a flat rate of 12.5%. But once you become a non-resident, you have only the option of selling and paying a 12.5% tax rate. So besides the strategy that you might have around how you want to keep that property or rent it out, there may be a tax angle as well, which you would want to consider when you're making a decision around the real estate piece. The when you move to that other country, because one is the decision on what you do with your property in India, the other is a decision around what do you do about buying another piece of real estate. So you have two options there again. One is either you rent when you go there, or you buy a property right away. The advantage of renting when you go there is that you get to explore neighborhoods, you get to see the job that you're doing, how convenient it is from there to get to your place of work. You, of course, have lesser upfront capital that you have to provide. You avoid getting tied down to a long-term mortgage because you're not very familiar with the geography yet very often. So there are advantages of renting because of the flexibility it gives you, but the disadvantage is that whatever money you pay out as a rent does not end up building equity for you. So essentially, it is an outflow without it creating value in the property that you are participating in. And you may also be subject to how the rents fluctuate in that particular geography. So let's say if the rents are going up rapidly, if you're renting, you run the risk of being exposed to the rent fluctuations in that geography. In contrast, if you choose to buy, you have the advantage of the fact that maybe the real estate investment will be a good long-term investment for you. And it can build you both emotional as well as economical stability. And there may be in that geography also certain tax benefits that arise by owning property. The disadvantage there is that you would have a significant capital outflow. You may have to again get tied to a specific location, so it takes away flexibility. And if you don't fully understand that geography, there could be certain legal and financial processes in that geography which you may not be exposed to, which can make it very time consuming at a time where you're already trying to settle down in a new geography with your family. Maybe you have children, they are schooling, education for them, your own professional exposures, etc. So you need to keep in mind that there will be a trade-off that you might end up making in this whole process when you choose to buy. And therefore, ideally, our recommendation when people are moving overseas with their international property investment decision is that at least initially rent, settle down there. If you have decided then to stay for a long period of time, then maybe you can think about buying a house. Again, it doesn't have to be that you have to buy a house, but you can now give it a very serious thought on whether this becomes an option for you to consider. As far as insurance is concerned, it's also very important to cover that aspect. It tends to very often in our mind get a lower priority. So there are two parts to insurance. One is health insurance, the second is life insurance. Remember that you probably need your own health insurance, even if you have employer cover, because you may not always be employed by that particular employer. And in periods where you are out of employment, you may or may not have an insurance cover available. And one of the things that clearly exists is in a lot of international geographies, healthcare costs are significantly higher than they are in India. So you do want to keep in mind that your Indian health policy may not cover you abroad. And therefore, you want to look at what kind of an international health insurance cover you will get for yourself and your family. And also, as and when you have family members who visit you, maybe for short periods of time, like parents, you want to be sure that there is adequate health insurance coverage that they are also getting during that period of time. As far as life insurance is concerned, many of the insurance companies in India offer a global coverage, which means that if you bought the term life insurance policies in India, You can continue to keep them, but it's ideal that you inform your insurer about the change in residency just to ensure that claim settlement subsequently, if it ever comes up, is not impacted as a result of the fact that there was no information about this transition. Coming to succession planning, which is essentially about taking care of assets that you would have already created. It's very important that when you move out of the country and you start creating assets outside the country, whether it's real estate assets, whether it's financial assets, whether it is pension assets, very often a single will may no longer be enough. And therefore, it is suggested that you consider creating two separate wills, one for your assets in India, one for your assets in that new country where you will reside. Uh, we need to keep in mind that a nomination may not be enough for two reasons. One is that a nominee does not supersede a will. A nominee is only a custodian of an asset. And therefore, if you want to ensure that your assets are getting transferred to the intended heirs correctly, a will is a superior route as compared to a nomination. And the second thing you need to keep in mind is that international jurisdictions typically do not have a nomination format at all. And therefore, a will is the natural process by which transmission of assets happen in those particular geographies. And you may want to therefore ensure that you have created a will to cover all these assets. Very often, when people start off, uh, they tend to ignore this aspect. And while it's a low probability that something happens to you, you need to keep in mind that if you're in a foreign jurisdiction, you don't want your family struggling because there is a situation where you find this that the assets have got created, but the access to those assets for your family now becomes very difficult because it gets stuck in the laws of that particular country in terms of how it works. One of the other things that you may want to consider, considering that you're moving out of the country, is whether you want to give a power of attorney for a family member in India, for someone you trust, so that things that are your local assets may get managed easily while you're overseas. Um, this could be bank accounts, it could be securities, it could be even real estate. And what this does is it makes it seamless in terms of how you manage your assets. Of course, you need to keep in mind is that a power of attorney does give a lot of rights to that individual to make decisions on your behalf. And therefore, you need to ensure that you'll give it to someone who you trust completely, who will act on the basis of what you tell them, because of the fact that there is a lot of things that power of attorneys can effectively do, which is the same as what you could have done. So use it, think about it with care before you put it into place. Also, what you want to do is ensure that your taxes and compliance from an India perspective remains to date, which means that you need to file your India tax return. If you are not going to earn any income at all once you move out, then you have a choice not to file a tax return going forward. But it is a suggested practice that even after you move out of the country, even if you have no returns, it may be a good idea to, no taxes. It may be a good idea to file a tax return in India, um, so that there is continuity, so that as and when you choose to come back, your taxes are all in order. And if there is ever any query that comes up, your tax return has been filed, even if it was a nil tax return that was filed uh, by you. Similarly, a PAN card remains valid. There is no need for you to change your PAN card number as a result of you moving out. There will be TDS that will now become an important part of your life, probably a little bit more than what you were as a resident. So we spoke about capital gains, for example, but even on interest income, say from example from an NRO account, there will be TDS that will be deducted. Rental income may also be deducted. TDS may be deducted there as well. So there is an important piece that you need to keep in mind, that some of the tax uh, collection mechanisms that you work with might undergo a change because you become a non-resident. You also need to let your bank know, let your financial entities know, whoever you're dealing with, because they will then change KYCs, make other changes that might be involved as far as becoming a non-resident. and also update your address as your overseas address. Now, what may happen is that a lot of your communication in today's world may come through email, but an overseas address is necessary for a KYC to happen across financial institutions, and therefore it's important to be able to share that as well. So this is the part of what was when you're leaving the country, the way that you have to approach your finances from an overall perspective. I'll now move to the second part of this presentation, which is around the inbound journey, which is essentially that if you return back to India, how do you want to plan for it? I think one of the common threads across both these periods of time, and I can't emphasize that enough, is that you have to plan for this in advance. Uh, it is unfortunately too late if you start planning for your return to India after you have come back to India. In the same way, it is unfortunately too late if you are going to plan for your journey out of India once you've already gone out of India. So there is ideally, about 6 months to 12 months of planning in advance at least that you want to undertake before you get into some of these decisions. In fact, some of them as decisions may also be very important decisions because they could have tax implications for you in terms of how your income, which you are earning both in India as well as overseas, are actually treated when this happens. So I'm just going to repeat that more than once, that it is a very important item to do in advance rather than after the event has already happened. Now let's come to the tax bit from an overall perspective. When you are a person who lived overseas and come back to India, you could end up having three statuses at different points in time. The first status is what you had become, which was non-resident Indian, or what is called NRI. And typically what would happen as an NRI is India would tax you only on your India sourced income. The second status which is available to you, which is a temporary status that you can take advantage of, is what is called the resident but not ordinarily resident status, which is essentially RNOR. And it's a very, very important benefit that you can leverage when you're transitioning from being an NRI to a resident. Depending on how long you have been overseas, this can actually be taken advantage of for anywhere between 2 to 3 years very often. And what it allows you to do is you pay tax only on your India income, but your foreign income is generally exempt during this period of time. And therefore, there are certain calculations that are relevant, which I'm not getting into as a part of this webinar, but it would be important for anyone who's coming back to India or planning to come back to India to spend time with their India tax advisor to understand how long the status of RNOR is likely to be available as an advantage to them. The third status, which will typically happen after a few years, in most cases, is going to be the resident and ordinary resident, which is essentially ROR, or more commonly called resident. And that's what you were potentially before you left India, maybe a few years ago. And the moment this status is attained, your global income also becomes fully taxable in India. So this period of transition is a very important planning period because there could be certain things that could emerge during this period of time, which you can take advantage of and reduce your burden of taxes. One of the things that one needs to keep in mind is that more recently, India's default tax regime has moved to a more simplified tax regime. So typically the new tax regime is the default tax regime as far as India is concerned. And the other thing you want to keep in mind, both when you left India as well as when you're planning to come back to India, is keep in mind that there could be a double tax avoidance agreement between the geography that you are in and India, or the geography that you were in and in India. And what can happen is that if you're able to get a tax residency certificate and fill certain forms, there could be certain tax set-offs that may be available, which can allow you to lower your tax uh, in this whole transition, or at least ensure that you do not get taxed twice over in both the jurisdictions. And this is again something that we find doesn't often get enough attention, but can make a lot of impact on this decision around how you make this transition to come back to India. The other thing that might happen is that you have NRE and NR and FCNR accounts, which you might have created, as well as NRO accounts. As soon as you come back to India, you need to convert the accounts from that status into a resident status. Now, we need to keep in mind a few things here. Remember that your NRE funds and your FCNR funds were fully repatriable. Okay? And the interest was tax exempt. But the moment you convert these, the interest will become taxable. So essentially, the interest will now be taxable for you in both situations, as in NRI and as a resident. And what you can do is, as an NRO individual, even while you were overseas or when you are coming back to India, whatever funds you had in NRO accounts were repatriable up to a limit of $1 million per financial year. This will get replaced once you come back and become a resident, because as a resident, your limit to transfer money overseas is at 250,000 US dollars per financial year. So essentially, this limit, which was 1 million, will reduce to $250,000 once you come back to India. Once you move back in, again, as a NRI, as long as you're NRI, you cannot open a PPF account. If you already had it open, it hadn't finished 15 years, you have come back to India, you can continue to make contributions as a resident. Once again, your stock and demat account, you now have to convert from non-resident to resident. Typically, what will happen is very often a new account will get opened, or new demat and trading account will get opened, and your securities will get transferred into that resident account. And this is important for you to manage your money correctly once you move back. And even on the mutual funds, you will need to update your KYC to show that you are now a resident. Again, what had happened, if you recollect, when you became an NRI, is that you were subject to TDS when you sold a mutual fund, for example. Now, once you move back to resident status, there will be no TDS, but there will still be a tax that you will have to pay of capital gains, depending on how it is. So just to give you a very quick update and comparative update on how to look at taxation of interest income by residential status. As an NRI, your NRE interest is tax exempt. Your NRO account interest is taxable. Your FCNR account interest is again tax exempt. And there is a fourth type of account, which is called a resident foreign currency account, which is not available to you until you become a resident. And therefore, it's been put there as not applicable. But when we talk about other statuses, you might find that there is an opportunity there as well available to you. So here, when we talk about taxation, once again, I'm wanting to just repeat that this is from an India tax perspective. As an NRI, you could still have this interest taxable in the foreign jurisdiction that you are in. And therefore, that part of the tax bit, you need to consult with a tax advisor in that geography. When you become a resident but not ordinary resident, your NRE account will become, the interest there will become taxable. Your NRO account was anyway taxable. Your FCNR can continue to be tax exempt till it matures. And that money can be moved to what is called a resident foreign currency account. A resident foreign currency account essentially allows you to retain the asset in a foreign currency and protect you from currency fluctuation till a particular point in time. And the advantage that you have is that during the status of RNOR, it is tax exempt, the interest that you earn there. Once you become a resident, an ordinary resident, automatically you have to convert your account from NRO to resident, from NRE to resident. Both those interests will be taxable. The FCNR interest will also become taxable, and the RSC will also become taxable. So you will notice that as you transition from one stage to another, even within your bank accounts, the taxability starts to change. And therefore, it's very, very important when you're making this transition to have your tax advisor very clued in to how this transition is happening, because the choice of accounts, how you want to approach it, etc., may vary depending on the status at different points in time. Coming to capital gains, like I mentioned earlier, one of the important differences on capital gains comes for property, where if you're a non-resident, you have no other option but to pay tax at 12.5% on capital gains without any benefit of indexation, which means you cannot adjust for inflation. In the case of residents, if you bought the property before July 23rd, 2024, you have the option to choose between a 20% tax rate with indexation or a 12.5% without indexation, whatever is more beneficial to you. The important part here, though, to keep in mind again, is that these are India tax laws. So what happens is when you're in a foreign jurisdiction, that jurisdiction could have their own tax laws as far as how they tax you if you are a tax resident in that particular geography. And therefore, you need to always keep in mind that what we are talking about here is the tax from an India point of view. There could be another tax implication from the overseas point of view, and that could also depend on the double tax avoidance arrangement between India and that foreign country. As far as other assets are concerned, in most cases, the tax treatment is similar, whether you are non-resident or resident. So listed equities and equity mutual funds, for example, short-term capital gain in India is taxed at 20%. Short-term is defined as less than 12 months. Long-term, which is over 12 months, is taxed at 12.5%. And you have a 1.25 lakh rupees portion, which is exempt when you make these capital gains. As far as debt funds are concerned, there is no indexation. It is all added to your income and taxed at the marginal tax rate. And if you have unlisted shares or other assets, your long-term holding period is now 12 months, and that will actually end up getting taxed at 12.5%. 24 months, and that'll get taxed at 12.5%. And short-term capital gains will get taxed at your slab rate. So this is the same whether you're resident or non-resident. It's more important to just keep it in mind. What happens is when you come back, you need to keep in mind that one of the things that we see as a common error that happens is that people say that, because I created these assets when I was overseas, I don't need to declare them here in the India jurisdiction. It is mandatory once you become a resident, an ordinary resident person, that even though you can hold those foreign assets, you must disclose all those foreign assets, whether they're bank accounts, stocks, real estate. This all has to get disclosed as a part of your income tax return. So the assets get disclosed and the income also gets disclosed, because the income may be subject to a tax from an India point of view. Like I mentioned earlier, if you want to hedge your currency exposure that you built up so carefully when you were overseas, you have the option to use an RFC account to hold the assets in a foreign currency itself. And if you want to repatriate any money out of the country, like I mentioned earlier, there may be certain types of forms that become important for you to keep in mind, because what ends up happening is there are certain types of elements that are required, and you might hear this quite commonly as a NRI, saying that a Form 15 CA-CB is required. Basically, this is a authorization through a form that a tax advisor makes online, confirming that whatever was the tax deduction at source and any taxes that were to be paid have been paid before this remittance is being put into place. And therefore, it's again very important that you think about this holistically. Some of these items are relevant to you even as a non-resident, even as a resident. So what you may feel is that, once I come back to India, I may never remit money overseas at all. But we do find that there could still be things which are happening, because This is a transition that is taking place. There could be certain assets that you have overseas for which you have to send money from India out of the country. Your status might have already become resident. So there will be a lot of different things that will come into play as you lead this life of being a global citizen. Some of the more practical things that you will also want to think about is besides the very hardcore financial tax other aspects is that you do want to consider buying an Indian health insurance again in advance before you come back to India. And this could be well in advance because many health insurance policies will have waiting periods attached to them, or you may become uninsurable because of a certain health situation that happens in your life. And what you want to do is take advantage of the fact that Indian healthcare overall is quite cost efficient. It's also reasonably high quality. And therefore, what you want to take advantage of is that maybe I want to pre-buy this healthcare so that one of the important parts of my financial plan is well covered. You also may need to keep in mind that there are certain regulations around what you can bring in and what you can't bring in because of customs duties, because of what is classified as personal belongings, etc. And there is a free allowance which tends to be quite small. So you want to be mindful that when you're shipping things from that foreign jurisdiction back to India, you want to be aware of some of the customs duties laws so that you don't end up getting a surprise suddenly when you're doing this. For example, one of the things that people want to commonly do is import the vehicle that they had. Very often, there will be a large amount of duty that might have to be paid on that imported vehicle. And therefore, it may be more practical to buy a new car in India when you come in. You may also have to deal with reintegration socially and from a career perspective. So there might be what we call a reverse culture shock. India may be different from the time that it was when you left the country. And every time you came back over these years, you may have come for short durations of time. You may have been on holiday. You may have been not exposed to daily life and some of the challenges that you may face on an ongoing basis. So you need to be prepared for that. Your family also needs to be prepared for that. You may need to actively build and rebuild local networks. You may need to change your career narrative to local market needs. And of course, because you may have children, you need to help them transition to a new educational system because what they may have been used to as a style of teaching, as a curriculum, and a lot of those things could now undergo a change automatically because India may have a different approach. This is also something that has changed a little bit because some of the curriculum that you now learn in India, like the international curriculums, are common across multiple geographies. So it's another part that you want to keep in mind as you think about it practically. Again, when you're coming back to India, you want to think about whether you want to rent or you want to buy. The advantage of rent, once again, is no long-term commitment. I come back to India, I decide which city I want to live in. I decide which part of the city I want to live in. I understand what's convenient. I keep my capital preserved. I, get my HRA benefits by renting, etc., depending on the tax regime that I opt for. Or I go ahead and buy. So it could be a good long-term investment. You could end up getting some tax deductions, but it's taking away flexibility for you. And therefore, just like when you were, leaving the country and you wanted the flexibility, it is suggested that at least for a year or two before you come back, you keep this rental option as your preferred choice. And once you're clearer, once you've returned, then you can make a more informed decision about where you want to settle down, how you want to settle down, etc. Obviously, there could be a little bit of a cost outflow that you may worry about, but it's in our experience, it's very, very worth it against the flexibility that you build up in the process. As far as insurance planning is concerned, like I mentioned earlier, buy that Indian health insurance before you return. Remember that there could be certain tax benefits available, but don't buy it for just the tax reasons. On the life insurance side, look at your existing life insurance, see whether you need more. Indian life insurance policies have fairly effective and cost efficient premiums. And if your dependents are going to be in India, it may be very efficient to have an insurance policy in India because it may be much easier to claim. And again, depending on the type of tax regime that you choose, there may be certain tax benefits that are available for you on the premiums that you pay. You may also need to update other things. So there might be, car insurance policies. Maybe you've got certain other elements. So you need to look at all of these things comprehensively, because the moment you transition, it's very likely that those policies are not going to be valid anymore. And therefore, you either need new policies or you need to keep your existing Indian policies going with a relook which is thoughtful. Last but not the least, again, you know, keep in mind your succession plan even when you come back to India, because you may retain certain international assets, and therefore it's still relevant for your will, your nomination. If there is a particular type of jurisdiction that is more efficient to use a family trust for, you may deliberately choose to use a private family trust for high value assets, because it may help with either inheritance taxes or estate duties that may be there in that particular jurisdiction. And every jurisdiction could have different laws as far as gifting is concerned, as far as transfers are concerned, etc., in terms of taxation. And there might be limits as well above which there is no tax or there is tax. And therefore, what you want to keep in mind is that when you're making decisions, they need to be more thoughtful and they may be more deliberate. And therefore, one of the things I would always suggest is that there is a need for someone who understands multiple jurisdictions to advise you from a legal perspective, from a tax perspective, and from a financial perspective. And very often, these people would be different from each other because the level of specialization across jurisdictions could end up being very high. So just to um, sort of summarize some of the other aspects which may be important for particular people, uh, because a lot of people are now moving back from the US. For example, there may be pension accounts in the US which are not taxed in the US, but they could end up getting taxed from an India point of view. And there is a section which was introduced in 2021 which allows you to defer your tax on your foreign retirement accounts until you actually withdraw the money, which is how the taxes in that international jurisdiction work. But there is a set of processes that you need to follow to take advantage of the Section 89A relief. So again, it's important to keep some of this in mind. Do it in advance before you come back to India, so that some of these elements can actually be properly addressed once you come back to India, or maybe even before you come back to India. We already spoke about the international bank accounts, but one important thing to keep in mind is that there is no compulsion to close your international bank accounts once you come back, but you have to disclose them as a part of your Schedule FA, which is your foreign assets disclosure, as a part of your income tax return. And therefore, our suggestion overall is focus on your banking, focus on your investments, focus on your real estate, focus on insurance, get your documents in order. All of this is important because this will plug in one part of what you need to do. Simultaneously, don't forget working on tax status. Don't forget working on your foreign asset reporting. Don't forget working on compliance. And don't forget on choosing the right partners as you go through this journey, because a lot of this can be quite complicated when you go through this entire journey, and you might want to reach out to your network to figure out, both internationally and in India, to figure out how you go about doing this in a very detailed manner. So thank you very much for patiently listening to all that we had to say on each of these items. If there are any questions, please put them into the box. I have about 5, 10, um, uh, 5 or 7 minutes to take questions. Um, I'm just going to pick up some of the questions that um, can sit here. I'll try to keep it generic to a larger group of audience, because there might be something specific to particular countries which may not interest the entire audience. But to the extent that I can keep it generic, I'll try to do that. Um, so, what is TDS percentage for sale of mutual funds is a question that came in. So, the TDS percentage depends on whether it is short term or long term. It also may depend on the type of fund that you are investing in. So, different types of mutual funds may have a different TDS percentage. And also, because of the double tax avoidance arrangement between certain geographies, in consultation with a tax advisor, an investor might actually end up finding that there are certain jurisdictions where the TDS could potentially get waived off as well. So that's something that you may want to keep in mind, that this is not a one size fit all solution. It will depend on jurisdiction. It will depend on double tax avoidance. It will depend on the type of mutual fund that you will have. Uh, Another question that came in was that, was the indexation benefit on real estate transactions removed recently? The answer is yes. It happened in the budget presented last year, which was July 23rd, 2024, the final budget that got presented. And therefore, what now ends up happening is that the second part of this question was, what is the optimum route to manage this? I think, different people may have different solutions for this, depending on whether you plan to live overseas, continuously, whether you plan to, come back to India at some point in time. Because if you come back as a resident, then the way that you might want to look at it may be different. So I think it will require a very customized solution where you will have to sit with your um, tax advisor and try to understand what will be the solution that will come up there. Again, I'm just for the benefit of everyone, staying away from answering questions which are specific to a particular jurisdiction, because there are some questions around UK tax, some around Australia tax, etc. I'm just, for the benefit of the overall audience, keeping that out. The question is, if we sell house property in India and buy property overseas, can we offset LTCG? As per our understanding, that is not possible, because it talks about a resident buying a residential property in India for an offset, and therefore that set off will probably not be permitted when you're doing it. To the question which has come is, if someone is planning to return to India after a decade or so, does it make sense to have a health policy in India to avoid policy denials, exclusions, etc.? The answer is definitely yes. It is highly suggested, because you don't know about what will happen in your life in this period when you're overseas, and whether you will still be eligible for health insurance once you come back. There's another question asking, for a will to be valid in India, what needs to be done to cover all movable and immovable assets? Normally, what you will find is that for a valid will, all that needs to be done is that it needs to be signed by the person who's writing out the will, who's called the testator. And it needs to be witnessed by two particular individuals who can certify that the um, person who was writing out the will signed it in their presence. Uh, Everything else, which is, how to write the will, content inside it, etc., is very much determined by the simplicity or complexity around it that one wants to create. But for validity of a will, just these two items are typically enough for the will to be created. Um, So a question around, is it mandatory to give overseas address for KYC updation when you become NRI? The answer is yes, it is mandatory, um, that you will have to give an overseas address to become an NRI. Um, um, uh, I'm just trying to run through the questions, keeping in mind that we probably have another minute to cover. Um, there's a question around, we have resident, non-resident, RFC, NRO, all these accounts there. What about foreign accounts? Let's say there's an account in Singapore, Dubai. What would be the status of that account? You can continue to maintain them. Any earnings that you have on them will be subject to tax if you have become resident in India after you return. If you're in RNOR status, there may not be tax on that. And you will have to report it as a part of your foreign assets once you become a resident as well. Mutual fund SIPs can typically continue, but because you're doing a KYC transition, there may be certain steps that you have to do, and there may be certain installments of your SIP that may have got a little bit adjusted as a result of that. Um, and sorry, I'm just seeing if I can take one last question in a minute. Uh, yeah. So can a NRI open PIS account with multiple DPs? I think this is something that's very important, that when you go overseas or you're an NRI, you have what is called a PIS account, which is essentially a portfolio investment scheme account, which has certain types of reporting that it creates as an obligation on the bank that opens the PIS account for you. And you are allowed to have only one PIS account, but you can have what are called PIS extensions that are available to you if there is a need to have um, more than one person manage your securities for you. So I'll just stop here. Sorry, there are a few unanswered questions, but I'm just mindful that we are at 4:59 p.m. So thank you so much for patiently listening out.
Thank you so much, sir. I would like to extend a heartfelt thanks for taking time and speaking at the webinar. Your insights, knowledge, and PPT as well made a truly a lasting impact on our audience. Thank you, sir.